California's economy drives the growth of state and local tax revenues. So each year, when the LAO prepares a forecast of the state budget, we start by developing our own forecast for California's economy. Like the rest of the U.S., California continues to feel the effects of the very deep recession that technically ended in 2009. Here in California, the recession cost us 1.4 million jobs. Since then, we've gained back only about 60% of those jobs. But the economy here has been gaining. Our forecast anticipates that California's employment gains will continue, with growth in construction jobs as the housing market continues to recover, with growth in healthcare jobs, with growth in professional and business service jobs, among others. And we project that in 2015, California's number of jobs will reach the point where it was before the recession began. In the last few years, the federal government has taken actions that have slowed the growth of the economy. Now, in our forecast, we assume that over the next few years at least, there are no further big spending cuts on top of the ones already put in place, no big additional tax increases over the next few years. And we also assume that there's little or no negative effect from any future federal government shutdowns or debt ceiling debates. Now, federal policy has been a wild card for the economy recently, so this is definitely one area where actual performance could differ from the assumptions we make, or that any other economic forecaster makes. Another important part of federal policy is the Federal Reserve's control of monetary decisions. In recent years, the Federal Reserve has had a policy of keeping its interest rates very low and purchasing large amounts of various types of securities to help boost economic growth. Our forecast assumes that the Federal Reserve begins to taper down those purchases beginning late this year or early next year, and that the Federal Reserve only very gradually in future years begins to increase interest rates. Stock and bond investors will make a lot of decisions based in part on the Federal Reserve's actions. So this too is an area where if the Federal Reserve acts differently from what we assume, the results for the economy and for the state budget could vary somewhat. While some parts of the economy have been somewhat weaker than we expected in our recent forecast, the stock market has been quite a bit stronger. In recent years, over a number of years, California's leaders and voters have made the decisions to tax higher income Californians at higher tax rates. Those higher income Californians receive a lot of volatile income, bonuses and stock options, as well as capital gains, which are realized gains on the sale of assets like stocks and houses. And that income's volatile. It goes up and down from one year to the next. So in our state's personal income tax, which makes up about 2/3 of our general fund revenues, there's no getting around it. A budget forecast for the state of California has to involve assumptions about what's going to happen in the stock market. And the stock market has been doing very well lately. That is one big reason why we project that state revenues will be quite a bit higher than assumed in the Budget Act that the state passed in June. In particular, across all revenue sources in the general fund, we forecast that the state will book revenues $1.6 billion above what the budget assumed in 2012-13 and $4.75 billion above what it assumed for 2013-14. Now, while we try to be open about the assumptions in our forecast, no one can forecast exactly what's going to happen in the stock market in the next few months or the next few years. So that's why California's leaders, when they make budget decisions, should think about the possibility that capital gains won't materialize as projected, about why housing and construction jobs might not gain as we're anticipating, about why California's corporate tax might continue to lag national profit trends. We encourage state leaders to build prudent budget reserves and to be careful about ongoing budget commitments in order to deal with the possibility that some of those risks might materialize.